idea of the unanimity of the Fed, 17 and 19 at 5% or higher. And then you also have that point in the minutes, which stood out from the last one. No Fed rate member sees a rate cut in 2023. It was a bit like the Fed showing the back of the hand to the market.
Interesting. All right, Brian, do you think the market's going to end up slapping the Fed around?
Eventually, yes. I don't think quite yet. Yes, the market is often right and ahead of the Fed. But I think tomorrow you're going to see the Fed go 25. I think they must feel pretty good. Inflation is coming out a bit lower than they expected. They'll have to lower their forecasts. They're not happy about growth being close to zero, but it's not negative. So I think you'll see a Fed that is resolute, that they're not going to ease. They'll push back against the market, but the market probably won't care.
And meanwhile, Chris, I look at your notes, and you say the case for recession is getting stronger and stronger. 5 indicators that are either rarely or never wrong that continue to say recession is ahead. Those all sound familiar, Steve. We talk about them all the time. Inverted yield curve, falling PMIs, contracting M2, soft home building, and falling leading indicators. And Chris, as an equities guy, what do you do?
Well, first, I don't think you panic, but I also think that you don't have FOMO. You don't have the fear of missing out with this strong market because, the market has predicted, 8 of the last 2 recessions, but it's also predicted 8 of the last 2 comebacks. What I mean is, I don't think this is going to be a strong comeback. I think by mid-year, things will have slowed down markedly. And so this is kind of a nice time to take some profits, Kelly, and also kind of pick and choose more with a rifle than with a shotgun about where you want to be in this market.
And the home builders, you and I talked about this months ago when when they were trading at 2 and 3 times, and now you think that's kind of run its course?
I do. I mean, they're up. We own the NVR, which had decent earnings today, but the stock's up 45% since June, and some home builders are up even more. So they're discounting good news that may or may not come true. So I think it may be time to take some profits off the table there.
Brian, I'm trying to figure out with the new sort of popular kid in town, which is kind of fixed income, and so munis, I don't know, all parts of fixed income have people kind of salivating with these yields, but I'm trying to think through what Steve just told us, and the likelihood of a downturn or of rate cuts that are coming, and how does that maybe change what parts of the curve you think people want to be in right now?
Yeah, I think it's really interesting, and it's weird to be popular in fixed income, but we are a little bit. Listen, the front end of the yield curve, the Fed is trying to entice you to go there, and I think you should, right? To get 4 3/4, 5% for a little while, I think is a great return. It should steal capital. I think the dangerous part is that 2 to 5 year part of the curve where everyone always puts money, but that's where the eases are priced in. So if those don't come, you don't get enough, I don't think, to go there. But when you go further out into the 10-year point, listen, at some point down the road, the Fed will raise rates enough to cause things to slow down. So owning longer duration quality assets and locking in that yield. We haven't seen yields up this level in 7, 8, 10 years. I think locking some of those in munis are great. Investment grade corporates are great. A little bit of high yield in there, but we're popular for a reason. The income is pretty good.
One thing, Steve, that I find a little bit curious is people saying, yes, the Fed should, or maybe it will. Maybe it won't pause after this meeting. Maybe it's the next one. But they say they can't pause prematurely because otherwise equities would fly. And this idea that, especially if we're heading into a slowdown, that the Fed is going to be afraid of letting stocks rally too much in what could end up being a bear market bounce. I'm curious what your take would be on that.
I spend an enormous amount of time gaming out what I think Powell's going to say. I've come to a dead end about him saying almost anything positive about the outlook for rates. If you think about it, these two guys are sitting there with their finger itchy on the trigger, right? If Powell says, we think we're nearing the end of the rate hike cycle, boom, hit it. If the Powell says, we think maybe the risks are now balanced between inflation and growth, market's going to hit that. If they say something like, we believe that we may have to, he will never say this, have to reverse course towards the end. The market is poised and ready to bounce on it. He has to be monotone and not make almost any comment at all about that could be perceived as dovish because of what you just said.
But here's my controversial question. Why should that matter? Why are they so afraid of a stock market rally, especially one that could end up being a dead end if the economy is slowing?
I think what they see the stock market as is just another piece of the financial conditions index They do not believe, what they want is they want an economy that is running below potential to create slack, to bring down inflation. They're concerned right now. Financial conditions have not really tightened a lot. They've actually loosened a little bit since the Fed went up to that 5% forecast. And an economy where rates are essentially, or the market rate is essentially juicing growth, is one that is not one the Fed believes will reduce inflation.
And Chris, if he, to Steve's point, and as the market seems to be kind of snuffing out, if Powell comes out and does his best tomorrow to make sure there's no hint of them doing anything other than further rate hikes, what is that likely to mean for stocks in the meantime?
You know, the market right now, Kelly, seems to, take everything as a glass half full. What I would say to the watchers is, hey, be careful what you wish for, because if you really think the Fed's going to cut by the end of the year, what kind of circumstances would lead this Fed, which, as Steve said, has given the back of its hand to the market, to cut?
Right.
And I think the only thing that would lead you to do that is some really bad situations in both earnings and in the equity market. So, so again, be careful what you wish for here.
Exactly. No, it's well said. By the way, I just want to mention a couple of other names that you are looking at here. Domino's Pizza comes up on your screen. First Republic Bank. So there are places that you think people can ride this out?
Absolutely. And the good thing about a bear market, and we're still in a bear market, is there are opportunities created. First Republic is a terrific bank, and from peak to trough, it was down 50% into October. It's come back a little bit, but that's a great franchise. It's a